Hey everyone, it's Eric Thompson. I'm president of Windermere Real Estate here in Colorado. Thank you so much for engaging with this video. We're making this for you just in case you missed our annual forecast event. We're going to give you a recap of what we shared and what we talked about during that event. Or maybe you were there and you want to get a little refresher. In that case, that's great. We're glad you're re-engaging with us. So this is all about our forecast for 2018 for Metro Denver. So as we go along here, you may have questions, you may have comments. You might want to ask us for resources. Just use this email address, colorado@windermere.com. We'd love to help you out. We can get some information in your hands. We'll get some answers to you. Again, email us at colorado@windermere.com. All right, so in case you don't know anything about Windermere, you may already know, but just in case you don't, real quick about our company. This is where we're located. We're in these 11 states, plus Mexico, all across the western U.S. We have 6,000 agents. We have 300 offices. And we are growing in Colorado. We came to Colorado 3 years ago, December of 2014, and here we are today. We have 7 offices all up and down the Front Range. Our newest offices are in Windsor and also Evergreen. We're now close to 100 people here along the Front Range to serve you, and we expect to continue to grow as time goes on across Colorado. All right, so one thing that's helping us grow is our Windermere Certified Listing Program. So this is kind of like buying a certified pre-owned car. It's one way that we really help out all of our sellers. What happens is all of our listings go through a consistent 10-step process to get the home ready for the market. At the key, at kind of the core of that process is the 5-point pre-inspection. So we pre-inspect every single home. So the point is we uncover any issues that the buyer may find, and we find those things before the buyer does so that we can make a great decision about how to handle those issues, and we find that the sellers really enjoy it, the buyers enjoy the transparency, and we see that we're getting very differentiated results from the rest of the market. So this is one thing that makes us really different. If you're thinking about selling, I encourage you to check out our Certified Listing Program, and we'll show you how it can help you. All right, so this video really is all about this question. It's all about this question, how is the market? How's the market is a question that we hear from our clients all the time, and we're going to go through that question. We're going to answer that question for you right now in this video. So let's start with what were the headlines of 2017. In 2017, there were 4 things that really jumped out at us. There were 4 big items of news when it came to residential real estate in Metro Denver. First one, of course, no surprise, is apartments. Apartments are really booming, right? So as you drive around Metro Denver, you see all kinds of apartments being built. You see the cranes going up. Apartment construction right now is running at double the long-term average. In a few moments, I'll show you what that means for rental rates and also vacancy rates, because you may be wondering, what does all this new construction mean for apartments? The other big newsworthy item is low inventory. Inventory is low for homes for sale all across Metro Denver. Now, not in every specific price range, not in every specific geographic location in Metro Denver, yet in most places this is an issue, and the issue is low inventory. December of 2017 was the lowest month in recorded history for homes for sale on the market. Get this, 10 years ago, there were 20,000 more homes for sale on the market compared to today. So we're watching inventory really drop. I'll show you a graph in a little bit that demonstrates that low inventory and what's happening in Metro Denver market. All right, and the third headline is that, of course, prices are going up. Because inventory is low, because demand continues to be high, prices can only go up. We'll show you by how much here in a few moments. All right, and the fourth headline is that volume has gone up by 150% since 2011. So in 2011, in Metro Denver, there's about $10 billion of residential real estate sold. In 2017, there was $25 billion. Can you imagine that? 150% increase since 2011, all driven by the prices going up and, of course, more and more sales over time as demand continues to be really, really strong. So Metro Denver, no surprise, as we all know, is a really strong, really healthy, really growing real estate market. All right, so those are some short-term trends that we just looked at. How about for the long term? How does Colorado perform over the long term? This is some really interesting information that comes from the Federal Housing Finance Authority. They track metropolitan markets all across the country. They also track states. So they track about 300 markets across the country, plus they track individual states. This is their most recent ranking of states. They happen to include Washington, D.C. in the state ranking. I'm not sure why, but they do. So this is a list of the top 10 states in the country for home price appreciation. You see Colorado here ranked 10th in terms of 1 year appreciation, but doing pretty well over 1 year. But what I want you to notice is way out here, look at this, since 1991 in Colorado, look at that appreciation that has occurred across our state and look at it relative to these other locations. If you include Washington, D.C., we're ranked second. And if you were to see all 50 states ranked on this screen, you would notice that Colorado is ranked second on that list. If you throw out Washington, D.C. and say it's not a state, and just look at the states, Colorado is ranked first since 1991 for home price appreciation. So over the long term, Colorado is proven to be a terrific place to own real estate. All right, so we were lucky enough to have with us at our forecast event our chief economist, Matthew Gardner. He showed us all kinds of really interesting, really insightful information. If you want to see all of his slides, use the email address that we showed you before. I'll show you that email address here at the end of the video. I'm going to show you right now, excuse me, just a couple of his slides, some things that I thought were really interesting that he shared. I think you'll find them to be interesting also. Let's first look at his prediction of GDP. So GDP, of course, is gross domestic product. He expects GDP to go up this year by about 2.5%. That's strong, that's really healthy growth for our national economy. Of course, that's going to mean good things for national real estate. So one kind of entertaining and funny and interesting stat that he's created is what's called the Gardner Misery Index. So even though it has a funny title, it is very insightful. So what he's done is he combines unemployment and inflation, adds those two numbers together, he comes up with the Gardner Misery Index. So the Gardner Misery Index, you can see over time, has been going down, so we've been becoming, I guess, less miserable. And so today you can see that as at a really low number. We have low unemployment and we have low inflation. Those two things combined to be really good. We are now less miserable. Okay, so one thing that we're noticing across the whole country, not just in Metro Denver, but across the whole country, is that there's nothing for sale. Inventory is super low all across the country, in most places across the nation. This is a dynamic. It's not just specific to Metro Denver. Look at this. Homes for sale today, if we look nationwide, about equal the number of homes for sale way back in the year 2000, even though there are more homes today because there are more people since the year 2000. So there are more homes out there, but there are fewer homes for sale dramatically since 2007, 2008. There's a very low amount of homes for sale across the whole country. All right, so sales continue to rise though. So sales continue to rise across the country because there's more and more demand, because our economy is healthy. When jobs grow, real estate grows, so there's more demand, there's more sales occurring. And a big reason for this is the first-time buyer. The first-time buyer is now back, and so because they're not moving out of a place, it makes it really easy for them to enter the market. And so we see more and more new home buyers, more and more first-time buyers entering our market. That's really good for real estate. One thing that Matthew shared with us is the median tenure for homeowners nationwide. So you can see it's gone up by almost half since the year 2000. So today, people are living in their home for a little bit over 8 years. Back in 2000, it was more like 4 years. This is a big reason why there's a shortage of inventory across the whole country, is because people are staying in their homes longer. When they stay in their homes longer, of course, that means there are fewer homes available for sale on the market. This is Matthew's prediction for interest rates. What he predicts for rates 1 year from now is 4.4%. That is about 0.5% higher compared to today. In a little bit, I'll show you what that would mean to a buyer. So if a buyer is considering maybe today buying versus buying in a year, if they were to wait a year, I'm going to show you what that would mean to them in terms of a monthly payment. What about the home ownership rate? So this is a look at what's going on nationwide for the home ownership rate. You can see the bubble right here. So there we were bopping along for many years at about 64, 65% of all people were homeowners. Then the bubble formed, and it formed because of policies coming out of Washington, D.C., because of really bad mortgage products that made it too easy for people to buy homes. People were buying homes that shouldn't have been buying homes. Then the bubble burst and it got back down to really where it needs to be. So it took a pretty dramatic drop, and now you can see it's back on the way up, and we expect it to get back to very close to the long-term average of where it's always been. All right, so what's Matthew's prediction for economic growth and employment growth? And what he looked at is he focused on the Western U.S. because that's where our company is located. That's where we focus on, is the Western U.S. You can see Colorado stacking up really well against these other states in the Western U.S. It's really Colorado and Utah that stand out as the places where we're going to see the most economic growth, the most employment growth. Of course, that means great things for real estate. This is now a closer look at employment growth across the Front Range. And you can see northern Colorado performing really well, expected to do well with employment growth, places like Fort Collins and Greeley and Boulder. And here's Denver with the expectation to grow 3.6%, which, by the way, is very strong, very healthy. Even though we're seeing it lower on this list, that is a very strong economic indicator, which will mean great things for real estate. Now, I'm going to tell you the story of what's happening in Metro Denver real estate. I'm going to show you some numbers, and then we'll get into our predictions for next year. First of all, let's start with prices. What have prices done year over year? Well, you can see first they've gone up considerably since 2013. So what you're looking at is the average price of a single-family home in Metro Denver. We're now approaching $480,000. Back in 2013, it was $335,000, roughly $150,000 increase in that time since 2013. What does that mean? That means that anyone that's lived in their home that long has a tremendous amount of equity in their home, and that's what's allowing them to move up. That's really one reason why prices are growing so much, is that people have so much equity coming out of their home, they can move up to their home they've always dreamed of. Year over year, prices went up 8.5%. By the way, a year ago, we predicted that they would go up 8%, so we were pretty close to what really happened. Prices went up about 8.5%. Year over year, and we expect more of the same into next year, and I'll show you more about that here in a little bit. This is a long-term look at home price appreciation. This comes from that same source, FHFA, the Federal Housing Finance Authority, 40 years of data going all the way back, what's happening every single year for home price appreciation. When the blue bars go up, that's good. If the blue bar goes down, that's bad. So what you notice is many more up years compared to down years. Over the long term, over 40 years, we average about 5.5%. So about 5.5% year over year appreciation is the long-term average for Metro Denver. That's super healthy. The other thing that's healthy is that when things go bad, they don't go all that bad. So right here is the Great Recession. You can see when we had the worst economy of our lifetime, prices only went down by about 2% per year. Compare that to a place like Los Angeles. Look what happened to them. 2008, their prices in LA went down 22%, so it was 10 times worse. So what we notice in Metro Denver, we tend to be insulated from the big wild swings of places like LA or Miami or Las Vegas and Phoenix and places like that tend to see these big wild swings in their market. We show more strong, steady, consistent growth. As an example of that, we looked at something called the 10-year rhythm. So we wanted to see, is there any pattern that emerges if you look at the 40 years of data? If you were to break it into 4 individual 10-year segments, what shows up? What kind of pattern shows up? And what I'm going to show you is really interesting. I'm going to show you the pattern that did come to the surface, all right? So here's the pattern that we saw. So over the long term, again, 40 years of data, about 5.5% is the average year over year increase. And yet, if you break that down into individual 10-year segments, what happens within each of those 10 years? Well, within each of those 10 years, the average price appreciation is about the same as the long-term average. They're about the same as each other. So we don't see any 10-year period being really different or really strange or really abnormal compared to the long-term, or really abnormal compared to other 10-year segments. This is really unique. This is really different. This is an example of why Metro Denver is a healthy, strong, consistent market. It's predictable, and that's one thing that gives us comfort as we think about investing and owning real estate in Metro Denver. All right, so that's the 10-year rhythm. Now I'm going to show you something fun called the Alligator Graph. This comes from our friends at the Denver Metro Association of Realtors. They track a lot of statistics for the Denver Metro area. We call it the Alligator Graph because it looks like the mouth of an alligator. The numbers on here are going to be really small, but what's more important than the numbers is the trend. So I'm going to show you the trend here, I'm going to show you the shape of an alligator. That looks like an alligator mouth, right? So this is over time. The yellow line up here are the number of homes for sale on the market in Metro Denver, going all the way back to 2008, so about 10 years ago. This is when I said there are 20,000 more homes on the market 10 years ago compared to today. The reason why you're seeing these waves in the graph, the up and down, that's seasonality, right? So we tend to see in the spring and summer more homes come on the market. That's why there's waves in this graph. But you can see, demonstrated here visually since 2008, you can see the inventory really just plummeting. Again, 20,000 fewer homes for sale today. What's the blue line? The blue line is number of transactions. So number of transactions, that's also seasonal, more sales in the spring and summer. And you can see a slight trend up over time, and that's demand increasing over time. So we've had inventory plummeting, we've had demand increasing over time. That means that prices are going up. That's why we're seeing this strong price appreciation that we are today. How about apartments? So we mentioned before, all kinds of apartments being built right now, double the long-term average. What does that mean? First, for rental rates. You would think maybe with all these new apartments that rental rates must come down. Are we oversupplying the market with apartments? Is that causing rental rates to go down? Turns out we're not. So rental rates are still going up. Year over year, you can see the considerable growth since 2013 for average rental rates approaching $500, a little over $400 a month change since 2013, and we still see growth in monthly rental rates. This all, by the way, comes to the Colorado Division of Housing. They also track vacancy rates. So you might think that with all these new apartments, are we oversupplying the market with apartments? Is that causing vacancy rates to skyrocket? Turns out no, it's still hovering right around 5%. We see a slight increase. Definitely this is a number that we have our eye on going into the future. We're going to be looking at this closely as new apartments are being built, and we're going to watch to see if this number changes. Right now it's not. It's still showing a really strong rental market. How about new home construction? This graph that I'm going to show you comes from our friends at Metro Study. They are pros, they are experts at tracking the numbers with new home construction across Metro Denver. And they look at annual starts and annual closings. So the red line is how many homes get started. The black line is how many homes close, how many homes actually sell. We take this back to 2003. We take it back to 2003 is that's when the bubble was forming, right? That's when we were oversupplying the market with new homes. So here's what's interesting about this graph. Today, we're only starting about half as many new homes as we were back when the bubble was forming. This is an answer that we give when people get concerned or worried about a housing bubble. They don't want a repeat of what happened in 2008. Well, the one reason why we don't think that's happening is because we are not oversupplying the market with new homes. Again, we're only running about half of what we were back then. So even though we see all these new homes being built, new neighborhoods being developed, we're still only half of what it was compared to back 2003, 2004 kind of time frame. Okay, one thing that does exist though with new homes, it's like there's a moat. There's a moat between what the buyer wants and what the builder can deliver. There's this really significant barrier, and it's very challenging for the builders to deliver what the buyer wants in terms of a price point. So many buyers want a price point under $400,000. It's become incredibly challenging for a builder to deliver a product under $400,000 because of labor costs, because of land costs, because of material costs, right? So here are the numbers behind it. 46% of all sales in Metro Denver are below $400,000, so almost half, and yet only 19% of the new product is below $400,000. So what's a builder to do? How do they solve that problem? How do they get across the moat? What's the bridge across the moat? Well, there are two bridges across the moat. One is multifamily. So this is the fastest growing part of the new home industry is multifamily, so condominiums, townhomes. That's a way that a builder, a developer can meet a price point. The other way for them to meet the price point is to get creative. They're going to get creative, and we're seeing this now with them getting creative with their floor plans and also with their lots. So if they find ways to get more efficient with the home itself and with the size of the lot, they can meet a price point. Here's an example. This is product that's being built and sold across the Front Range right now. You can see that the builder's gotten creative. They've gotten small lots here, they've gotten small homes, and some buyers are being attracted to this because they'd rather have this than share a wall and be in a condominium or a townhome. All right, so if there's any risk, and by the way, obviously we're showing you lots of good news here. If there's any risk here in the market, The risk lives in one place. The risk lives with interest rates. This is a long-term look at mortgage rates, the 30-year mortgage rate going back about 40 years. Going back 40 years, the average is 7.5%. Today, we're essentially half of that, so money is on sale, half off. And so if rates go up, as Matthew Gardner predicts, we follow and we watch what's called the 1%, 10% rule of thumb. So for every 1% increase in interest rate, there's a 10% increase in the monthly payment. What does that mean as a real-life example? And we're going to show you a real-life example. One of our listings that's for sale, it actually went under contract really quick, so when we put this PowerPoint together, it was for sale. Now it's under contract, but let's suppose that someone was interested in buying a home like this today, and then maybe they're considering, maybe they would wait a year. So this home went on the market at $375. Today's interest rate's a little under 4%. You can see what that does for the monthly payment. If that person were to say, you know what, I think I'll wait a year for a home like this, well, based on our prediction, prices will go up 8%, and based on Matthew's prediction, interest rates will be 4.4. You can see what that does to the monthly payment. It's about $200 a month in the monthly payment. That's the impact. That is the cost of waiting. So here's some things that we have our eye on. Here's some things that we're watching as we go into 2018. A big one that we have our eye on, a big dynamic in the market, of course, is multiple offers. This is a real life scenario where we had a listing, we had 14 offers on it, and I remember back in the day, I've been doing this 25 years. I remember back in the day, you would get in one offer, you would show it to the seller, we'd go through the good and the bad of that offer, and then we would strategize on how to respond to the buyer. Today, we build grids and spreadsheets to help a seller understand all the different offers. By the way, after we've thrown out the bad ones, so we throw out some of the 14 that obviously are not going to qualify, and then we help the seller understand each offer individually and the dynamics of that offer, and then we select the one that has the highest odds of closing. So we've become very adept at that in helping a seller to decipher and sift through all the offers that they may get. Again, this doesn't happen in every single part of our market, and yet this is a dynamic happening very frequently in Metro Denver. So for example, this last December, 41% of all sales in Metro Denver were for at least list price. Back last May, when things were really hot in the springtime, 64% of all sales were for at least list price. So multiple offers is a dynamic, and we expect that to continue in many parts of our market going forward. All right, so what do we expect for 2018? This is what we're looking at as terms of our predicted headlines for this upcoming year. Here we go. We expect prices to rise. Again, we expect prices to go up another 8%. So they went up a little over 8% last year. We expect something similar going into this year. Because of high demand, because of low supply, prices will continue to go up. We expect 8%. We expect 59,000 transactions in the metro market. That's a slight increase over 2017. We expect that increase because demand continues to be really strong, more and more people moving here. We expect this dynamic of low inventory to persist. It will live on. We don't see anything big on the horizon that would change that dynamic. We'd also expect that multifamily will really grow. So the multifamily market will continue to be the fastest growing segment of the new home industry so that builders can hit that low price point. In this market, the move-up buyer wins. They're earning so much equity in their home. They're able to move up to the home of their dreams. In many cases, they're able to move up into a price range where there's not as much activity so that they maybe won't be in that competing situation. So it's really the move-up buyer who wins today. And we expect that our company will grow. We're looking at other strategic locations all across the Front Range, really all across Colorado. So that's another headline that we're expecting for our company in 2018. So I want to thank you so much for engaging with this video, hoping this is helpful to you. Here's some other things that might help you out. Reach out to us using this email address, colorado@windermere.com, if you want things like our newsletter. So our newsletter is called the Windermere Report. We print this every month. We mail it out to our clients. It gives you really interesting statistics and information, kind of like the information that we've been going through here in this video. If you want this newsletter, if you're not already getting it, reach out to us at colorado@windermere.com. This is an example of our e-newsletter. Our e-newsletter is zip code specific. You choose the zip codes that you'd like to track. We send that to you every month so you can see what's happening right in the neighborhoods that you would like to watch. And you also may wonder, well, what's my home worth? I'm hearing all this information about prices going up. I wonder what that means for my home specifically. Even if you're not thinking of selling, we can help you with this information. We'll get this in your hands. We'll show you what your home may be worth in today's market. Again, email us at colorado@windermere.com. You may have questions, comments about this video. You may want some of these resources that we just showed you. We would be more than happy to help you out. Again, my name is Eric Thompson. I'm president of Windermere Real Estate here in Colorado, and I just want to thank you so much for engaging with this video.